Hello, and welcome to the Basic Tax Course, Session 6. This session will cover Social Security and Railroad Retirement Income. Hello again, and welcome to the Session 6 Basic Tax Course. We're going to start out this session by reviewing Session 5 quiz, Most Frequently Missed Questions. So we're going to start off with number 1. Mary, born in 1935, retired during the year. She decided to take $30,000 from her pension as a lump sum distribution. She will take the remaining balance in her plan as a pension of $400 each month for the rest of her life. How much of Mary's lump sum distribution is eligible for the 10-year tax option? The answer here is B. None of Mary's pension is eligible for the 10-year tax option. And the reason for this is because Mary did not take her entire pension as a lump sum distribution. She is still going to be receiving the balance after her partial distribution as a monthly amount. This option is only available to someone who takes the entire pension balance as a lump sum distribution. Our next question is 5. Tony and Janet are married filing jointly, and both are under 50 years of age. In 2012, Tony's taxable compensation is only $1,500, and Janet's compensation is $58,500. Tony contributed all $1,500 of his earnings to a Roth IRA. Neither Tony nor Janet is covered by a retirement plan at work. What is the maximum amount Janet may deduct for traditional IRA contributions for herself and for Tony? Well, we give you the options of A, 0, B, $5,000, C, $8,500, or D, $10,000. And the correct answer here is C, $8,500. Since neither Tony nor Janet are covered by a retirement plan at work, they're allowed to take their maximum allowable contribution. Janet, under the age 50, has a maximum allowable contribution of $5,000, and Tony, also under the age of 50, has a maximum allowable contribution of $5,000, although he already contributed $1,500 to a Roth IRA. So that leaves a balance of $3,500 for Tony. If you add the $5,000 to the $3,500, you end up with C, $8,500. Question 8. Generally, you must begin receiving distributions from your traditional IRA no later than which of the following dates? Well, this has been a frequently missed question for a number of years for students. It is clearly stated in Pub 590 on page 34 that April 1st of the year following the year in which you reach age 70 and a half. So answer D is the correct answer. And our final question for this quiz is question 18. Minnie's tax return for 2012 shows the following income: $800 in wages, $6,490 in unemployment compensation, $1,000 in alimony, and $8,000 in rental income from apartment buildings she owns. What is Minnie's compensation income for the purpose of determining how much she can contribute to an IRA? Well, in order to figure this out, we need to be looking at earned income / compensation for an IRA contribution. It is stated that this includes wages, salaries, commissions, self-employment, alimony, and separate maintenance, and also non-taxable combat pay. It does not include unemployment compensation, nor does it include any rental income. If we look at Minnie's amounts, we have $800 in wages, $1,000 in alimony. That adds up to $1,800, and the correct answer for this question is B, $1,800. That concludes our review of the Session 5 quiz, Frequently Missed Questions. You will now continue on and listen to Session 6 lecture video.
Social Security and equivalent railroad retirement benefits. If you are receiving Social Security benefits, you will receive Form SSA 1099, and if you are receiving railroad retirement benefits, you will receive Form RRB 1099. Tax treatment of Social Security and railroad equivalent Social Security is identical. Form RRB 1099 is generally printed in blue ink, and so I have for you here RRB 1099. It is the equivalent of SSA 1099. And of course, most SSA 1099 forms come printed kind of in pink. These boxes on them are a pinkish color, and the RRB form is blue. But whether you have the RRB 1099 or the SSA 1099, they mean the same thing. They mean that you have a Social Security benefit, and you're going to apply the rules for Social Security benefits in determining how much of that benefit is taxable. And figuring out by hand how much of a Social Security benefit is taxable takes a little bit of work and a great deal of understanding about how the formula works to determine the taxability of Social Security, and that's what we're going to be looking at today. Just as a starting point, I want you to take a look at Box 5 on the SSA 1099 and compare that to Box 5 on the RRB 1099. Those are the boxes we care about in terms of doing the calculation for the taxability of benefits received. Now, we treat RRB Tier 1 benefits in the same manner that we treat Social Security, but if you are a retiree from the railroad, then you are also going to have regular pension coming from the railroad. And if you have regular pension and Social Security equivalent coming from the railroad, you will receive an RRB Form 1099-R. You can see it says 1099-R as opposed to just 1099. And the distinction between those two is that the 1099 from the railroad is taxed as Social Security, and the 1099-R from the railroad is taxed as a regular pension. If you are receiving railroad retirement benefits, do not confuse Tier 1 and Tier 2 because they are taxed so differently. And the way you determine or differentiate between the two is by looking to the name, but also the color. The Social Security equivalent of railroad benefits is in blue ink, and the 1099-R pension equivalent on railroad retirement is printed in green ink. And here is an actual statement. I've had a number of clients over the years bring these in to me, and when you unfold them, they're usually all attached together in a line like you see here, with the Social Security equivalent up top, and then 3 copies in green below. And of course, 1 copy is for attaching to the federal return, 1 copy for the state return, and 1 copy for the retirees' records. And since you don't typically mail in a copy of the Social Security statement, that is only a single copy provided. And like wage income and pension income, Social Security is subject to tax from most filers who receive it, or at least a high percentage of filers who receive it. And as such, it may be advisable for your client to have income tax withheld from their Social Security benefits. In fact, if we go back up and look at the SSA form, you will see Box 6 reads Voluntary Federal Income Tax Withheld. That tells you it is possible to have federal tax withheld, and although most Social Security recipients don't choose to have federal withholding, it may be advisable that they do have federal withholding. I frequently find clients that receive Social Security are in a situation where they have large balance dues with their federal return because they had no withholding on their Social Security benefits. And if you've got, even a reasonable size pension coming in of $30,000 a year, and you also receive Social Security of, say, $15,000 a year, you're going to have most of your Social Security benefits getting taxed, and to not have any withholding on that means you're either going to have to pay estimated tax as you go throughout the year, or you're going to owe when you file, and neither of those are very pretty. Now, of course, the states are not allowed to tax Social Security, so when you do fill out a W-4, you're only going to achieve federal withholding, no state withholding, by completing it. The big difference between a W-4V, which is used for Social Security withholding, and the W-4 that's used for wage withholding, or the W-4P that's used for pension withholding, is that when you are doing Social Security withholding, you are only allowed to hold a percentage out. You have to select the percentage rate of withholding that you want to go at. There's no worksheet that you fill out to figure out whether you're going to be filing single or married, whether you want an additional dollar amount held out each month. Those options are not provided. You simply decide how much percentage-wise you want to have withheld from Social Security. And I kind of look at how much my client owes, look at what their gross Social Security amount is for the year, and figure out what percentage they should have had withheld and check the box that's closest to that number, and then I send them on their way. So where do they go with this form once they filled it out? Well, the instructions, and I get these off of the Social Security site, the Social Security Administration site, not off the form itself or off of the IRS site. Social Security says that you sign the form and return it to your local Social Security office by mail or in person. Next topic is the taxability of Social Security. And taxable Social Security benefits include monthly survivor and disability benefits, but they do not confuse Social Security with supplemental security income, or SSI, because SSI is not taxable. Sometimes I have clients who are confused about whether or not they're receiving Social Security payments or SSI, because you can receive Social Security when you are disabled. And how do you know the difference? Getting to the technicalities of it, the only thing I care about is whether or not they received an SSA 1099 form, because if they did, it's taxable. And non-taxable SSI is not reported on an SSA 1099 form. So that's the clue that you would look for. How do you figure the taxable part of your Social Security benefits? Well, you do that in most cases by filling out worksheet number 1. And one of the things I should tell you about worksheets that I basically have the opinion of on all IRS worksheets is that the worksheets are used to help you apply tax laws. And if you know the law well enough, you actually don't need the worksheet. The other big difference between a worksheet and a form is that the IRS typically says fill out the worksheet and then keep it in your records. Do not attach it to the tax return. So a worksheet like here, it says keep for your records. If you were filing a paper tax return, the IRS does not want you to mail this worksheet in. But they would say, hey, fill the worksheet out to figure out how much taxable Social Security you're going to put on the front page of the 1040, and then retain it for your records. But keeping in line with that speech I just gave, if you know the law well enough, you can figure the taxable part of a Social Security distribution without ever filling the worksheet out at all. And I'm not going to ask you to do that here and now, but actually for people who are enrolled in our classes and taking our quizzes at the end, as self-study students, we actually do throw some calculations at you where we're expecting you to at least know part of the calculation, even if you don't know the whole calculation. So here we have the worksheet, and you can see that up at the top, it asks you to determine what your filing status is going to be on your tax return. Whether if your filing status is married filing separately, then essentially you don't even need to bother with the worksheet because 85% of your benefits are taxable and you're done. But it does say, and I'll zoom in close enough for you to see it, if you are married filing separately and you lived apart from your spouse for all of 2012, enter D to the right of the word benefits. And essentially, if you lived apart from your spouse for the entire year and you're filing separately, you will fill the worksheet out as if you are single or head of household and not apply the married filing separate rule. So here are the rules about the taxability of Social Security. Up to 85% of your Social Security or Railroad Tier 1 benefits may be taxable. To find out whether any of your benefits are taxable, compare the base amount for your filing status with the total of 1/2 of the benefits you receive, plus all of your other income, including tax-exempt interest. When making the comparison, do not exclude any income that you have excluded on your tax return that was interest from qualified U.S. savings bonds, employer-provided adoption benefits, the foreign earned income or foreign housing exclusion, or income earned in American Samoa or Puerto Rico by bona fide residents. The base amount that you start with for most filers, who are not going to worry about these 4 exceptions because most people aren't affected by that, essentially what you're going to do is you're going to look at your adjusted gross income on your tax return, subtract out from your adjusted gross income all of your Social Security benefit, and then add half back in. And then if you had any tax-exempt interest reported on line 8B of the 1040, you're going to add that in as well. So that's what this first little formula right here is saying. You're then going to look at the total number you get. Is that total $25,000 or higher? If it is, and your filing status is single or head of household, that is the point at which your benefits start to become taxable. But if the number you get is under $25,000, then none of your benefits are taxable. And if you are married filing jointly, that base amount moves to $32,000. So let's run through it again. You take all of your income that you have for the year, except Social Security. And then to that number, you add half of your Social Security benefits. You compare the resulting total to the base amount for your filing status, which is $32,000 if you're filing a joint return, and $25,000 if you are single, head of household, or qualifying widow, or $25,000 if you were married filing separately but did not live with your spouse at any time during the year. If your income is below the amount shown for your filing status, none of your benefits are taxable. But the base amount you're allowed to use is zero if you're married filing separately and you lived with your spouse at any time during the year. So let's describe the worksheet methodology. I'm going to describe how the worksheet works, and then we're actually going to put the numbers on the worksheet so you can see what happens. Social Security benefit worksheet number 1 walks you through a series of calculations to help you determine the portion of your benefits that are taxable. The calculations work in 2 stages as follows. In stage 1, you add up all taxable income shown on lines 7 through 21 of your Form 1040, and then you add in any tax-exempt interest you received, but you do not include the Social Security benefits that you received. You subtract out all of the total of your adjustments to your income, but you add back in these special adjustment items, U.S. savings bond interest and the foreign earned income exclusion probably being the more common ones. And then to that total, you add back half of your Social Security benefits. You compare that total to the base amount for your filing status, $25,000 for every filing status except married, and then for married you have $32,000 or zero if you lived with your spouse but don't file jointly. If your modified adjusted gross income is less than your base amount, none of your benefits are taxable, and you don't need to enter the taxable amount on your tax return. But if you see that you have a number that's greater than the base amount, then some of your benefits become taxable. And to the extent that the number that you have, if you take your income, add half of your Social Security, and then subtract out the base amount, let's just say $25,000 here. To the extent that that difference is less than $9,000 or $12,000 if you're filing a joint return, then you'd simply take whatever that difference is, multiply it by 50%, and you have the taxable number. So that description is probably just making your head spin. It doesn't make any sense. But the form is having you do exactly that. That's what the form is telling you to do. And if you get the rules in your head, you don't need the worksheet. Password number 1 is NEO, N-E-O, NEO. So here's an example of how it would work. Katie, a single filer, received $20,000 of pension income and $15,000 of Social Security benefits. We're going to determine the taxable portion of her benefits as follows. We'll take the pension and add in half of her Social Security benefits. We get a number, I'm calling it her modified adjusted gross income number, $27,500. That's more than $25,000, so we subtract $25,000 from the $27,500 and we get a number. Her income that exceeds the base amount is $2,500. And because $2,500 is less than $9,000, we simply take $2,500, multiply it by 50%, and we get $1,250. This is the taxable amount of Social Security that she has for the year. And we would enter that as the taxable Social Security benefit for the year. No need to even do the worksheet. But let's do the worksheet anyway, just so I can prove it to you. Here is Katie's Social Security benefit worksheet. Line 1 says take her Social Security benefits for the year and multiply them by 50%, and you get $7,500. It then says take all of the other income she had for the year and enter that on line 3. That's her pension income of $20,000. We then add these two numbers and we get $27,500. We move down the worksheet until we get to the point that says, if you are single, enter $25,000, and she does. Then it says, subtract 25 from 27.5 and enter the total on line 10, 2,500. Then it says, enter 9,000 if you are single. So she does that. And then it says, enter the smaller of line 11 or line 10. In her case, that's line 10. So she enters 2,500. And then it says, enter half of line 13, and she does, and she gets $1,250. And then the rest of the worksheet is to arrive at that same number, $1,250. So without ever using the worksheet, I got the right answer. Let's look at stage 2, because stage 2 involves these extra lines down here, and they make things a little bit more complicated, but still doable without a worksheet. In stage 2, if your modified adjusted gross income, and I call it that, I don't think that the IRS instructions call it that, but I needed to give it a word, so I called it modified adjusted gross income. If your modified adjusted gross income exceeds your base amount by more than $9,000 if single, or more than $12,000 if married filing joint, then more than 50% of your benefits will be taxable. Multiply the amount by which your modified adjusted gross income exceeds 85%, and then add that amount to 50% of $9,000 if you are single, and 50% of $12,000 if you are married filing joint. Use the lesser of the number that you get, or 85% of your total benefits, to arrive at the amount of the benefits that are taxable. So let's see how that would work for another tax filer. This time we have a filer named Jordan. Jordan is single and had $30,000 of pension income and $10,000 of Social Security income for the year. Figure the taxable portion of his benefits as follows. He'll take the pension income of $30,000, add half of his Social Security benefits, and he gets $35,000. He takes the base amount for single of $25,000, subtracts that out, and gets $10,000. 10 is more than the next number, isn't it? The next number being 9. And so he's going to subtract 9 from 10, and he gets 1,000. He multiplies 1,000 by 85%, and he gets $850. And to that, he adds 50% of 9,000, and he gets $5,350. So more than half of his benefits are taxable. In fact, $5,350 of the $10,000 is taxable. The next part of the formula is to take $10,000, multiply it by 85%, and when you do that, you get $8,500. And $8,500 is more than $5,350, so $5,350 is the amount that is taxable and goes on Jordan's return. And here is the Social Security benefit worksheet completed for Jordan, just to prove how it all comes together. We start with his Social Security, multiply that by 50%, and enter the total on line 2. We take all of his other income in the world and add that to half his Social Security. We get $35,000. We then take $35,000, find his base amount, and subtract his base amount from $35,000. The resulting number is entered on line 10, and this time it is greater than the next number on the form, which is $9,000. So we subtract 9 from 10, and we get 1. And then this time we enter the lesser of line 10 or 11, and this time that lesser number is 9, so that moves to line 13. Then the instructions say multiply line 13 by 50% and enter the total. We do that, $4,500. We then take line 12, multiply that by 85%, we get $850. We add $850 to $4,500, and we get $5,350. The next stage is to look way back up at the top of the form, take his gross Social Security benefits and multiply those by 85%, and when you do that, you get $8,500. He gets the lesser of the amount on line 18 or the amount on line 17. In this case, 17 is the lower number. He enters $5,350 as his taxable benefit on his tax return. So what else can I teach you about Social Security? Well, there's a few other important facts, and then I'm going to give you time to work on a classwork assignment. And that classwork assignment surrounds the next topic of discussion, which is the lump sum election. Certain taxpayers may receive a lump sum payment of Social Security benefits in 2012 as a retroactive payment for benefits that they earned in earlier years but did not receive in the earlier years as they should have or as they were entitled to. These retroactive payments can occur when an individual applies for Social Security benefits in one year but receives them in a later year, or an initial application for benefits is declined and then awarded at a later time. And I see this one, reason number 2, frequently. It's a pretty common one, unfortunately. There seems to be almost a triggered response at the Social Security Administration that if you apply for Social Security benefits because you've become disabled, that Social Security seems pretty much automatically ready to deny it. And what I often see is that people who have become disabled, they apply for Social Security benefits, they have letters from doctors saying that they're permanently and totally disabled and therefore they should qualify, and Social Security puts up a fight. And sometimes it's necessary for them to hire attorneys, go to court, and finally they win, and that's when they get this lump sum benefit. So I don't see it happen every year, but I see it come up often enough that knowledge of how to deal with it is important. Now please note that this type of lump sum benefit payment should not be confused with the lump sum death benefit that both SSA and RRB pay to many of their beneficiaries, because no lump sum death benefit is subject to tax. Lump sum payments that are received in 2012 that include benefits for one or more earlier years are generally shown in Box 3 of either Form SSA 1099 or Form RRB 1099. And in the manual, the assignment that I'm going to have you working on is on page 62. So if we flip to page 62, you can see that we have an SSA 1099 statement for Mary Tate. It's showing that she received $35,000 of benefits in 2012, and of those benefits, $12,000 are for 2012, $12,000 was for 2011, and $11,000 was for 2010. So this is telling you that although she received $35,000 of benefits in 2012, the breakdown is that $23,000 of the $35,000 was for earlier years. So that's telling you I need to do something special for Mary Tate, and let's figure out what that is. So back here again on page 52 of the manual. You should report all benefits received in Box 5 of SSA 1099 for 2012 on your 2012 return, regardless of which earlier year the benefits received in 12 were for. So you will use your 2012 income to figure the taxable part of the total benefits you received in 2012, unless you elect to use the lump sum method to calculate your tax instead. The lump sum election allows you to calculate the taxability of your Social Security benefits using income from the year in which the benefits were due to be paid to you. You can elect this method if it lowers your taxable benefits. Now, determining if the lump sum method lowers your taxable benefits is the hard part. From a practical standpoint, it's been my experience as a practitioner that using the lump sum method requires a bunch of hand work to be done and rarely results in a lowering or a reduction in the taxable benefit. However, the possibility that there could be a lowering of the taxable benefit means it's worthwhile to understand what the rules are, how to do the calculation, and if and when it would benefit your client, go ahead and use it. So we're going to figure out how you do that. You follow these steps to apply the lump sum method. Firstly, you complete Worksheet 1 for 2012 based upon the entire distribution received in 12. So for the Tates, when we get to their classwork assignment, you're going to look at that SSA statement they received, and you will see that it says $47,000 of benefits were received during the year, and it's also going to show you the other income that they had from their retirement accounts during the year. And you're going to use that information to fill out Social Security Benefit Worksheet number 1. When you're done with Social Security Benefit Worksheet number 1, you're going to move on and complete Social Security Benefit Worksheet number 2 or 3 as appropriate. And in the case of the Tates, it's going to be Worksheet number 2. And Worksheet number 2, you begin by entering the earlier year for which you are completing the worksheet, and then you fill out the worksheet for the earlier year. And if there's more than one year, you do a separate Worksheet 2 for each earlier year that benefits were paid for. The final stage is to fill out Worksheet number 4. And Worksheet number 4 does a comparison of Worksheet 1 for the current year with benefits for the earlier years. And finally, you get a number on line 21. And if the number on line 21 of Worksheet 4 is less than the number you got on the final line of Worksheet number 1, you can use the number you get on line 21 of Worksheet number 4 instead of the number on Worksheet number 1. So how do you make the election? If you choose to report taxable benefits under the lump sum election method, finish completing Worksheet number 4. Then follow the instructions at the bottom of the worksheet. report the taxable benefits under the lump sum method on Form 1040, line 20B, then write LSE on the line next to line 20A, and do not attach the completed worksheets to your return. Retain them for your records. So you're going to tell the IRS that you applied the lump sum election method to the preparation of the 2012 return by entering LSE on the line next to line 20A and then entering the taxable benefits that you calculated on line 20A. Well, a way to make sense of that is by doing it. So in just a couple of minutes, we're going to take a break, and it'll be your final break of the day, and you can use that to do the classwork assignment. And then we'll use the last 10 minutes of today's class to actually review the answer key for that assignment. But before we break to work on the classwork assignment, I did want to give you some extra information on Social Security benefits. The first one is relating to Canadian or German Social Security benefits paid to U.S. residents. Under income tax treaties with Canada and Germany, Social Security benefits paid by those countries to U.S. residents are treated for U.S. income tax purposes as if they were paid under the Social Security legislation of the United States. If you receive Social Security benefits from Canada or Germany, include them on line 1 of Worksheet 1, and this rule applies to benefits from Canada and Germany only. And I've made a point of putting this last sentence in this paragraph because my students often ask me, well, what about every other country in the world? And the thing about IRS is when it writes a publication, it basically tells you what you can do. It very rarely tells you what you can't do. You can pretty much extrapolate you're not allowed to do something because they haven't told you that you are allowed to do it. And that is the case with this Canada and German Social Security benefit taxation rule. The IRS goes out of its way to tell you that Canada and Germany have a tax treaty with the United States that allows benefits from those countries to be taxed as if they were a benefit from the United States. But no similar treaty exists anywhere else, and the publication doesn't tell you that it only applies to Canada and Germany. It just says that if the benefit came from those countries, then it gets that treatment. And from Canada, it's not called Social Security. In Canada, it would be Canada Pension. If your client's receiving Canada Pension, then that is the equivalent of Social Security, but Canada doesn't call it Social Security. It has a different name, and I'm sure Germany has a different name too, and it would be spelled in German, wouldn't it? Special deductions relating to Social Security benefits. You may be entitled to deduct certain amounts relating to the benefits you receive. One of these relates to disability payments. If you received disability payments from your employer or an insurance company that you included in your tax return in an earlier year, and then you were required to repay those benefits after you received a lump sum payment from Social Security or Railroad Retirement, you can take an itemized deduction for the part of the payment that you included in gross income in the earlier year. If you repaid more than $3,000, you may be able to claim a tax credit instead. Well, let me just describe a situation where I have seen this happen. I have a client, had a client a few years ago, who became disabled, and she applied to Social Security and she was refused. Simultaneously, she applied for disability benefits through a plan provided by her employer. So she retired from working on disability. She did apply for Social Security, but it was refused. And then there was a lawsuit that ensued. I don't know who paid for it. Well, I guess it was her. She had to hire an attorney. At any rate, it came to a point where she won. And because she won, she had to repay all of the disability benefits that she'd received. And those are disability benefits that she had included in her income in the year in which she'd received them. So in the earlier year, she included those benefits in her income and she paid tax on them. And then in a later year, she has to repay them. So she's allowed to deduct those on her Schedule A. Simultaneously, she got this lump sum payment in from Social Security. And in the year that she had to do this repayment, and it was close to $100,000, she also received close to $100,000 of Social Security income. And so we had to do worksheets to see whether or not the lump sum method saved her any money. And we also had to claim an itemized deduction for the repayment that she made to the insurance company. Now, legal expenses, if you paid legal expenses to claim taxable Social Security benefits, you deduct these expenses as a miscellaneous itemized deduction on Schedule A of Form 1040, line 23. Social Security repayment, this can happen also. You may have received Social Security payments coming into you, and then you had to repay them. Why would that happen? Well, I see actually that happens quite often. Sometimes you'll see a client has applied to Social Security under a disability claim. They have been awarded the disability benefit, but then something happens and they get better. I actually had a client who became disabled. Something very bizarre happened to him where he pretty much lost all of his muscle tone and he couldn't walk anymore. He was struggling around on a cane. He was utterly and totally disabled. The doctors had no idea what was wrong with him. He just overnight changed. This robust, vibrant man who'd been my client for many years just withered away. And so he applied for Social Security disability and got it. And he was pulling it in for himself, and also his children were able to receive benefits. And they received those for about 2 or 3 years. And then the same thing happened, only in reverse. Overnight, he got better. No one knows why he got sick. No one knows why he got better. It just happened. So he was no longer disabled. And he went back to Social Security and said, okay, I'm better. Please stop issuing the benefits. Well, stopping Social Security is pretty much as difficult as starting Social Security. So from the time he told Social Security to stop making payments until the point in time where Social Security, in fact, did stop making the payments was more than a year. So for more than a year, he was continuing to receive taxable benefits coming in from Social Security until he got to a point where he had to start making repayment. So that is an example of why a repayment has to be made, but there's obviously more examples than that that go on in the real world. That's just what I've seen. So what happens when you make a repayment? Well, if the repayment of benefits that you received is for an earlier year, you will basically have a number shown in box 5 of the SSA or the RRB statement that includes benefits for this year minus any benefits repaid for earlier years. And so it's netted out in box 5. But if you get to a point on box 5 where box 5 is a negative number, it means that the repayments in the year are greater than the benefits received. So here is an example where you are able to deduct payments because they are greater than the benefits you received for the year. Peter and Mary Jane are filing a joint return for 2012. Peter received Form SSA 1099 showing $6,000 in box 5 of his form. And Mary Jane also received an SSA 1099, and the amount in box 5 of her form is $8,500. Well, if you take 85 and subtract 6, you have a negative number. And essentially it means that they would report 0 Social Security income for the year because they would subtract 6 from 8. They're left with 0 taxable Social Security. But because the repayment is more than the benefit received, they're going to enter $2,500 as an itemized deduction on line 23 of Schedule A. Now, if it happens to be the case that the repayment is $3,000 more than the benefits received or exceeds the benefits received by more than $3,000, then you also can claim the benefits repaid on Schedule A as a deduction, and you may not be subject to the 2% penalty either. So if you make a repayment of $3,000 or less, the 2% limit applies. You enter the repayment on line 23 of Schedule A as an itemized deduction subject to the 2% limit. But if you make repayments that are more than $3,000 more than the benefits received during the year, then you are not subject to the 2% limit, and you enter the repayment on Schedule A line 28, not subject to the 2% limit. So this is a lot going on. You receive Social Security during the year, and you make repayments during the year. Are the repayments more than the benefits received? Or perhaps you received no benefits at all, so the only thing you did is make repayments. How much were those repayments? How much more were your repayments than the benefits that you received? If the repayments are $3,000 or less, then it's an itemized deduction subject to the 2% limit. But if they're more than $3,000, then it's not subject to the 2% limit. And in addition, you might qualify to use alternate methods. Under method number 1, you basically enter the repayment on line 28 of Schedule A. Under method 2, you go back in time and figure the tax without the itemized deduction on Schedule A, and then go back to each earlier year for which you made a repayment and refigure tax for that earlier year as if you had not received the income in the first place. You then figure what the difference in tax for that earlier year is and compare that to the difference in tax for this year if you don't report it on Schedule A. And you're allowed to claim the more advantageous of those two methods. So you compare the figured tax amount under Method 1 and Method 2, and your tax for 2012 is the smaller of those two amounts. If you choose Method 1, take the itemized deduction on Schedule A, line 28. If Method 2 results in less tax, claim a credit from the amount from Step 3 above and then enter the resulting tax on line 71, or the resulting credit on line 71, and write IRC 1341 in the margin to the left of line 71. But if both methods result in exactly the same amount of tax, deduct the payment on Schedule A. So that concludes the lecture on pensions and Social Security. We're going to move down now to the classwork assignment that I said I'd be giving you for the last bit of today's class. Password number 2 is mansion, M-A-N-S-I-O-N, mansion. Jerry Tate and Mary Tate are married, and they are retired. Jerry is retired from the railroad. Mary is retired from ABC Company. Mary retired and applied for early Social Security benefits after she was diagnosed with a disability. And initially, Mary's application for Social Security benefits was declined. Then in 2012, Social Security made a lump sum payment for prior years and began paying benefits. Jerry and Mary's pension, RRB, and Social Security statements are attached, along with copies of the 1040A she has, or they have, for both 2010 and 2011. We would like you to prepare the federal return for the Tates, showing the lowest allowable federal tax for 2012. And to figure that, you're going to have to do Social Security benefits worksheets 1, 2, and 4. And the assignment shouldn't take you terribly long, but I'll give you 10 minutes to work on it. And during the 10 minutes, you can choose to do nothing and take a 10-minute break for the day, or you can choose to work your way through it. And here is the RRB 1099. This is the Social Security equivalent that Jerry received from the Railroad Retirement Board. It's $12,000. We have Mary Tate's pension statement showing $12,000 of taxable distribution. And then we have Mary Tate's 1099 from Social Security, $35,000 of benefit received from the year, $12,000 applicable to 2012, $12,000 applicable to 2011, and $11,000 applicable to 2010. We then have the 2010 1040 form for the Tates, and you can see that in 2010 they received $5,000 of Social Security benefits, not including Mary's benefit, and that none of it was taxable in that year. So their adjusted gross income for 2010 was $22,500. We move on to the next statement, and we see that in 2011 that Jerry received $12,000 of Social Security benefit, Mary received no benefit, and that their combined income for the year, adjusted gross income, is $20,000. And that is your assignment.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review.
Let's go and look at the finished answer key for Jerry and Mary Tate. So the starting point for the Tates is, of course, to figure their 1040 form and enter their pension income on it. And then we get to the point where it's time to enter their Social Security income, and now we have to stop and do a series of worksheets. The first worksheets that we complete are worksheet number 2, or you could do it in another order, but the first worksheet I filled out was worksheet number 2, and I did that for 2010, and I also did it for 2011. And on each of those worksheets, we start with the income that they have from pension and the income that they have from Social Security, and we add those numbers up. So we enter on line 1 of the Social Security worksheet the total Social Security benefits that they had for the year. And you can see by looking at the 2010 return, the amount of Social Security benefit that Jerry had received was $5,000. And you can see from the 1099 SSA that Mary received in 2012 that the benefit showing on that statement for 2010 was $11,000. So we take $5,000 received in 10 and add to that $11,000, which should have been received in 10 from Social Security, and we get $16,000. Then we do a worksheet number 2 for 2011, and this time on worksheet number 2, we're going to show the benefits that Jerry received in 2011, which was $12,000, And we also add in the amount of benefit that Mary would have received in 11 if she'd received it as she was supposed to, which is another $12,000. And we add those numbers up and we get $24,000. On worksheet number 4, we look at the amount of benefit that Mary received for 12 that was for 12. And we also enter the amount of benefit that Jerry received in 12. And we add those numbers up, we get $24,000. The next step for worksheet number 1 is to add up all of the benefits received in 2012 for 12 and earlier years. And Mary received $35,000 and Jerry received $12,000, and for that we get $47,000. So now we move over to worksheet number 1, and on worksheet number 1 we enter the total benefits received for the year of $47,000, and we divide that in half and we get $23,500. We then add in all of the other income that the Tates received in 2012, and that was combined pension income from Mary's pension plan and Jerry's railroad retirement that came to $32,000. We add half the Social Security benefits to the pension income received, and we get $55,500. We subtract the base amount for their filing status. We do the rest of the computations, and when we get to line 19, we come up with $15,775. That's the worst case scenario for the Tates, but the purpose of doing the other worksheets is to see if we can come out a little bit better. So we then move on to worksheet number 2, and we do a separate worksheet number 2 for both Jerry and Mary. And on this worksheet number 2, we enter the year that we're preparing it for, and the first worksheet we do is 2010. We show the Social Security benefits for 10, applicable to 10, even if they weren't reported in 10, and that was $16,000. We divide that by 2. We add it to the other income that they had for the year showing on their 2010 return, and we get $22,500. We add 8 to $22,500, and we get $30,500. $30,500 is less than $32,000. So none of their benefits are taxable if they had received them in 2010. We do the same computation for 11, and when we do that, we end up with the same result, that none of the benefits for 11 would have been taxed if they had been received in 11. So then we go over to worksheet number 4, and on worksheet number 4, we enter all of the benefits received for 2012 for 2012, and figure out what Social Security portion of the benefits for 2012 would be taxable in 2012 if that's the only benefit that was received for 12. And when we do that, we end up with $6,000 of Social Security benefits received in 12 for 12 that are taxable, and $6,000. And then we have no benefits for the earlier years that are taxable, and that's why $6,000 is the taxable portion. So just to summarize, we do worksheet number 1 to figure how much of the benefits received in 2012 would be taxable if we reported it all under benefits received as applicable to 12, and we get a number. We then figure how much of my benefits would have been taxed in the earlier year if I'd received them in the earlier year. And for both 10 and 11, we established that none of the benefits would have been taxable if they'd been received in the earlier year, as they should have been received. And if they had received those benefits in the earlier year, how much benefit would the Tates really have received in 12? Well, the benefits that the Tates really would have received in 12, if they'd only received benefits for 12, is $24,000. So we then essentially do the equivalent of worksheet 1 using only $24,000 of benefits. So we take $24,000, divide that by 2, we get 12. We add it to their other income for the year, we get 32. 32 plus 12 is 44. We subtract 32 from 4, and we get 12. And we then multiply 12 by 50%, and we have the final answer. So that is the amount of Social Security benefit that the Tates receive. And on their 1040 form, we're going to enter $32,000 of pension income, $47,000 of Social Security benefits received. We're going to type LSE on the line next to line 20A and enter $6,000 on line 20B. And that is the final result for the Tates for the year, $38,000 of income. So that is the conclusion of the lecture and the review of the classwork assignments for pension and Social Security income. I hope you enjoyed it. And for the next few minutes, I'll stand by to answer any questions any of you might have. I see a question here from Majid. If a taxpayer pays Social Security to Germany or Canada in early age of the life, how the pension department will pay taxpayer after retirement age? Well, If you are qualified for Social Security benefit equivalent from those two countries, and I'll use Canada as an example because I do tax returns from Canadians who receive those benefits, but it happens to be my parents are Canadian living here in the United States, and my father receives Canada pension. And you have to meet certain requirements in the country Canada to qualify for Canada pension. And if you qualify for Canada pension, you apply for it through Canada pension and begin to receive payments from Canada pension. The Canadian government and the Social Security Administration of the United States do talk to each other, and so the amount of Canada pension coming in is revealed to the United States. That is disclosed. I see a question coming in from Dawn Turner, and I see this same question every year at the end of this lecture, so I'm going to read it out because it's an important point. Dawn Turner asks, if the amount for the earlier years created a taxable amount, you would have to amend those earlier years, correct? And the answer is absolutely not. The IRS does not want you to go back and amend the prior year return. The reason is that the lump sum payment from Social Security was not received in the earlier year. And cash basis taxpayers report on a tax return only income they receive during the year. So if Mary Tate receives an $11,000 payment for 2010 in 2012, she doesn't report it on 2010, she reports it on 2012. But the calculation we do is to determine how much of that benefit is actually going to be taxed on 12, and we see the result is 0 got taxed on 12, because if she had received it in 10, it would not have been taxable in 10. Thank you for participating in Pacific Northwest Tax School's education programs. We hope to see you again soon. Bye-bye.
To complete this session, number 1, take the password test in the LMS. Number 2, complete the homework assignment and enter your answers into the LMS. And 3, complete the quiz and enter your answers into the LMS.
Password number 3 is CARS, C-A-R-S, CARS.